it seems that with each passing day, each passing week, there's a bit more conviction that perhaps this disruption is going to last longer. I think initially the view was maybe this will last a few weeks. The naval coalition gets formed and maybe there's some protection, but it does feel that this will last a bit longer. And thus far, I would say investors are still on the fence, but I would say consensus is probably looking at this lasting for at least the first quarter of the year.
Even if it lasts for the first quarter of the year, because obviously, it takes a lot of time to then, put the ships back on those routes as well. The thing that you mentioned about the expectations that we could see, the Fed easing off and then, what that means for consumer outcomes. If we were to see, because I would imagine that your premise and the upside for these stocks is based on the fact that this Red Sea disruption is going to cause increased prices. It's obviously beneficial for these companies. But if we were to have that continuation of the Red Sea issues coinciding with some kind of, negative macroeconomic event, whether it be, recession or significant recession in Europe, whether it be in the United States, what does that do for prices if we have both of those outcomes simultaneously?
Yeah, it's a great question. Well, I think typically demand is a much stronger driver of what's going to happen to freight rates across all different shipping segments. So what you need is clearly you need a bid from the demand side. But what we have seen, and this is different than what we've seen in the past, is there are multiple choke points that seem to be choking at the same time. It's been since the beginning of 22, where the outbreak of the Russia-Ukraine war, you've had the Black Sea, the Baltic Sea have been very, very tight, and it's caused tanker rates to move in longer distances. You've had the Panama Canal in 23 experience low water levels. That's really impacted gas carriers. And now you have the Suez Canal situation, or at least the Red Sea situation, that's impacting container shipping. So you have a substantial amount of supply side disruption that I don't want to say is unprecedented, but it's very rare to have seen this happen all at the same time.
All right. And so let's talk about your stock-specific ideas. You're upgrading Maersk to a buy. There is a hold on Hilag, and there's a hold on Zim.
Yeah, we upgraded Maersk last week, basically as a leading liner player. It's a very, we think, attractive company. It's large. It's got I would say, a market footprint across all the different geographic segments that matter in container shipping. But we think the stock's attractively valued. It trades at basically 60% of its book value, and as you mentioned, the stock was down. It's basically, we think, been a stock that was tossed to the side, really because, when we were coming into 2024, we thought it was going to be a tough year, but we felt that Maersk was well capitalized. It's got low leverage, it's diversified, and it's well equipped to navigate through the downturn. But the gravy in the near term, at least, is you've got a real substantial strengthening in the market that's going to lead them to have higher earnings and most likely have a stronger EBITDA for this year than anyone really expected coming into the year.